Most people think mortgages are based only on income, but many people that make good money get approved for less or even rejected because of their debts, not their salary. Let me explain how banks actually look at your income when you apply for a mortgage. Banks do not use your full salary to calculate the mortgage payments. Instead, they use a percentage of your salary to count towards housing costs. And then the other part is going to go towards debts. That means that if your debts are too high, then the mortgage approval drops. So even if you earn good money, it does not mean you can qualify for a house. And if you do, it would be for less if your debts are too high. Let's look at a practical example to see how debts affect how much home someone can afford. Imagine a household earning $90,000 per year combined. That equals about $7,500 per month before taxes. Lenders usually want total housing and debt payments combined to stay around 43% of income. So total allowed monthly obligations are about $3,225 per month. Now let's compare two situations. Scenario 1, household without any debt. If they have no car loans, no credit card balances, and no personal loans, the full $3,225 can go toward housing costs. Example housing breakdown. Mortgage payment could be about $2,650 per month. Property taxes around $375 a month. Heating estimate around $200 a month. So the total housing costs $3,225. With these numbers, the household could qualify roughly around a $500,000 home, depending on rates and conditions. Now let's look at scenario 2. Same household income, but now they have debts. Assume they have a car loan payment of $750 per month, credit cards and other loans that total about $250 per month. So their total debt payments are around $1,000 monthly. Since their total obligations must stay about $3,225, the housing cost must now fit within $3,225 minus $1,000. So that leaves us with $2,225 available for housing costs. So now the housing costs look like this. Mortgage payment about $1,650 per month. Property taxes around $375 per month, and heating around $200 per month. So the total housing cost equals $2,225. With this limit, the same household, the same family may now qualify closer to a $330,000 to $350,000 home instead of $500,000. Same income, but that's reduced buying power by around $150,000. And very often, the biggest payment making the difference is the car loan. Many households carry multiple debts at the same time. Credit cards, car loans, personal loans. Combine all this debt is going to reduce the amount of mortgage that you can qualify for. You might even end up getting declined. So a good solution for this is to consolidate all your debt. The way that this works is that you would apply for a new loan, which is going to help you pay off all these other debts that you have. The main idea is to reduce the payments, to reduce your monthly payments. So you have to calculate how much you're spending monthly on all these other debts at the same time. And then this new loan, by paying it off, you're going to have only one payment that should be lower. This way you're going to leave, or you're going to increase the amount of capacity that you have in your salary to qualify for a bigger amount, or to go from not being able to qualify into becoming eligible to qualify for a mortgage. Here's an example about consolidating debt using the same numbers that we used before. In the second scenario, the total monthly payments were $1,000 for debts. If these debts were consolidated into one payment of around $500 per month, then the total obligations would be $2,225 for housing plus $500 in debts, which totals about $2,725 per month. Now the household fits just under the lender's limit of $3,225 per month, improving the mortgage qualification. In this case, the benefits are that now your monthly payments are lower, which allows you to qualify for a larger home. It also helps reduce financial stress. The consolidation can also help improve the credit score over time, as multiple open accounts get managed with one regular payment. Discipline is required to prevent new debt from growing. So simply by reducing debt payments, the same household could increase their mortgage capacity and be able to qualify for a $400,000 home instead of a $350,000 home. The main lesson is this: before applying for new loans or getting some kind of financing, you have to consider how it's going to affect your mortgage potential, but even more important, how it's going to affect your future. What kind of things do you have planned, or what kind of goals you have plans for your future, and how are all these debts are going to block you from getting there. Sometimes taking care of that first can make a huge difference in what you can qualify for later. Buying a home is not only about income. It's about strategy and taking the right actions and the right steps towards achieving that goal. If you are thinking about buying, it's smart to review your situation early and develop a strategy. If you would like to look at your numbers and see how much you could qualify for today and what we can do to improve your situation and get you to qualify for a larger amount, reach out to me. I'm more than happy to help you. I will provide you expert advice and will guide you through the process of applying for a mortgage and getting you and your family into a brand new home.